Welcome to our discussion on financial instruments, and we will discuss today in this session briefly an introduction of the relevant accounting standards relating to financial instrument and a very brief introduction to the fair value, and later on we'll get into the details of financial instruments and the fair value concept. Um, the financial instruments accounting can be broadly divided into, or the standard deals with, meaning of financial instrument, measurements of financial instrument, the presentations of financial instrument and in the financial statements, and the corresponding disclosures. These are the issues which are covered in the financial instruments accounting standards. The standard has evolved over a period of time. It started maybe in 95 with the issue of the IAS 32, 98 IAS 39, as recently IFRS 7 and IFRS 13, which deals with the fair value. So in India also there is a corresponding standards have been issued, which is Accounting Standard 30, which is related to IAS 39, Accounting Standard 31, which is related to IAS 32, and Accounting Standard 32, which is same as IFRS 37. So therefore, in principle, as of now, they are more or less same, but later on we'll see how different is the India scenario because of the convergence project in some of our future classes. So what are these financial instruments? The financial instrument is a contract that results in a financial asset of one enterprise and a financial liability or equity of another enterprise. So it includes the financial assets, financial liabilities and equity of another entity. You can see that equity of own entity is not included here. I'll not get into this example at this juncture, but let me take you to a comprehensive examples which just gives you the list that financial instruments are cash, receivables, equity shares of other companies, bonds, debentures of other companies, creditors, bills payable, bank overdraft, bonds, debentures issued, and also the derivatives. What are non-financial instruments? Like plant, machinery, intangible assets, copyrights, own share, statutory liabilities like income tax payable. The reason why we are mentioning that is that though these are assets and liabilities, but this particular accounting standard will not deal with these assets. So financial instruments are very clearly defined where these accounting standards are applicable. So the first issue is initial recognition and the subsequent recognition of financial asset. All financial assets will have to be recorded at the fair value. That is initial recognition. The subsequent recognition may be at the fair value or may be at an amortized cost, but that depends on the classification of the financial instruments or financial assets. The classification, the financial assets are classified on the basis of the purpose, the period, intentions of acquiring and holding on to that. So financial assets can be classified into four broad categories. Financial assets at a fair value through PL, normally called as FVPL, loans and receivable, financial assets held till maturity, and the residuary head, that is the available for sale. All financial liabilities are classified into two categories: financial liabilities through PL, which is FVPL, and other liability. This classification of both assets and liabilities will decide the subsequent valuation. So initial recognition, as I mentioned earlier, all financial assets are recognized at the fair value, but the subsequent recognition like FVPL and available for sale are measured at the fair value. However, their unrealized gain, the difference, in case of FVPL, they are shown in the profit and loss account, whereas in case of an unrealized the unrealized gains and losses in case of available for sale, they are shown in the equity till they are realized. The distinction is because of the classification. So the classification has an effect on that. Whereas the other instruments like held till maturity and loans and receivable are reflected in amortized cost. What are these fair values and amortized costs? We'll pick up later to understand, because the fair value, there is a separate standard now. Similarly, the financial liabilities, all the financial liabilities have to be recorded at the respect to fair values, initial recognition, and the subsequent recognitions are measured at an amortized cost, which is generally using an effective rate, effective interest method. Exception is that fair value financial liabilities at the fair value through PL are always measured at the fair value. So this leads us to a question that what is this fair value is all about. Fair value is an amount which a liability can be exchanged, or asset can be exchanged, or liability be settled between a knowledgeable willing parties in an arm's length price. But as I mentioned, we have a separate accounting standard on that, and we'll pick that up in more details in one of the latest classes. So if you see the fair value, I'll skip these things for the time being, but to summarize that, in case of a held till maturity, the financial instruments are shown at the amortized cost, the loans and receivable at amortized cost, the gains and losses are not relevant, whereas in available for sale, they are shown at the fair value, but the changes, the fluctuations are transferred to the equity. In case of a fair value through PL, they're shown at the fair value every time. The gains and losses are transferred to the income statement. Most of the cases in the derivatives also, it is the same. So therefore, the financial instrument measurement is dependent to a large extent on the classification, and the classification depends on the management. So today, the principles or accounting policies affecting the classification will influence the measurement, presentation, and disclosure of financial instruments in the balance sheet. So with that, I would like to conclude for the time being, and we'll get back to we'll get into the details of the measurement, and particularly the financial instruments, and the impact of the fair value on the financial instruments. So thank you very much.